I'm Matt Bishar with REIT.com here in Atlanta for REITWorld 2014, NAREIT's annual convention for all things REIT. Joining me is Lisa Sarajian, Managing Director with Standard & Poor's Rating Services. Lisa, thanks so much for joining us.
My pleasure.
Now, S&P recently released its REIT industry report card, which had a positive outlook. What are the major factors driving that view?
Well, we think a stronger economy is driving both business and consumer confidence, which in turn is supporting pretty solid operating fundamentals for most property sectors, pretty much across the spectrum. And as a result, we've seen occupancy strengthen even for the beleaguered office sector and even some modest rental rate growth.
How do you weigh potential interest rate increases as it relates to REITs?
Well, we pretty much assume interest rates are going to rise. It's just a function of when they rise and how they rise. If rates are rising because the economy is strong and businesses are expanding, we think REITs are probably pretty well positioned to absorb the increase in rates because they can pass this on to their tenants in the form of higher rents. If there's a shock to the system, that could be a little more difficult to absorb, but we think REITs have done a pretty good job of managing their capital stack and their debt maturity schedules so that they'd have the cushion or the opportunity to handle an interest rate shock, so to speak. But having said that, we'll always see some company-specific situations where a company maybe is struggling to manage that kind of a shock.
And your report notes the strong capital markets available to REITs. Do you see that environment continuing, and how do you see that capital being used primarily?
Our base case scenario assumes continued healthy economic environment and that the current strong capital flows into the real estate sector that have been really supportive for REITs continues. But having said that, if capital flows were to be restricted, we do think REITs have the ability to pull other levers to raise capital. And we have seen pretty robust issuance this year, and the bulk of that capital seems to be, refinancing maturing debt, opportunistically pre-funding debt maturities, but it's also being directed toward development, which we've definitely seen, on the rise, and we're seeing some pretty healthy external growth in the way of acquisitions and some M&A. So we would anticipate that capital is going to be there and that we could see it used for a variety of reasons.
Great. Lisa, thank you so much for joining us today.
Thank you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.